All right, stocks had a very interesting reaction to Friday's half-day post-Thanksgiving just hangover. Big drop on, but not everybody kind of rebounded the same. Some areas of the market rebounded really well. The areas that we kind of talked about would on Fridays. Other areas didn't rebound as well. So we'll talk about which ones and what that means and what our expectations are. Like, did we bounce up enough to kind of nullify Friday's weakness? Was the areas that were weak, did they extend the losses and weakness to the point where now we don't expect them to bounce? So I'm going to break those areas down and talk about kind of from a technical perspective, again, what we expect to see for the rest of this week. We're also going to talk about what's kind of driving this action. There's some very clear trends going in different asset classes as well as different sectors in the U.S. We'll break that down. And our trade idea is a stock that's been its own little consolidation, a little different looking pattern than what we see more broadly. But we'll talk about how to trade it as a good example of how to take advantage of consolidations like we've seen. So let's go ahead and get started. Today is Monday, November the 29th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, really quick before we hit this market forecast chart, just a reminder here, we had a really good response over the weekend with our Black Friday sale, which is continuing through tomorrow. So the end of November 30th at midnight is when the sale ends. Our discount still applies through Cyber Monday. Again, it applies to our premium level of service, which is most of our subscribers. This is what you get for that. If you click on subscribe down here, or if you come up to the top and click on premium, this is where you can kind of see. You can see a lot of people have been using some of our premium resources to see as they get going on their website. Just make sure that when you use that coupon, it's still the same coupon code, Black Friday, just like that. Make sure that when you, if you want to use it, you got to be logged in and click on have a coupon right there, and then make sure you type it in, all one word, no spaces, capital B, a capital F. If you want to use PayPal 6 months, same as cash credit, PayPal credit that they have, again, you have to apply for that through them. That we have nothing to do with that. So once you've applied from that, make sure you log into their account, then you can pay with PayPal there, and then get that 6 month no interest deal there, and just check that box before you hit subscribe. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we're back above the 30-day moving average, back above the 23% retracement level, which is kind of what we expected to see, especially on like the S&P and the NASDAQ, because they were the ones that weren't nearly as bearish as the Dow and especially the Russell. The intermediate line dropped below 80, hence the light pink shading, but back above the rising moving average turns that line green instead of keeping it at yellow. Of course, short-term sentiment improved, but not very much. The momentum line came out of oversold levels, not surprisingly, but didn't really get to strong bullish levels either. The near-term line is actually still in bearish territory. It didn't drop to sharp lows. That was kind of one of the reasons why we weren't so bearish on the S&P. It's still in bearish territory. It's been in the lower half of the chart now for a while. Now, obviously, it's a lower low point, a near-term low, than the last low point. So now the question is, when the near-term line gets up, how far and how long will it stay up? How far will it go up? Of course, getting above 90, getting above 80 at least, but especially above 90 would really help. Just kind of be a good new near-term rally and keep this long-term run going. The NASDAQ looks very similar. The momentum line did jump to much stronger levels for the NASDAQ. You can see you got back above that 23% retracement, got back above a few high points there. The near-term line got back up. It did come out of bearish territory, even if it didn't quite get into bullish territory yet. Again, light pink shading with the intermediate line falling below 80, but still in bullish territory. You still have rising long-term market sentiment. Now the picture gets a little bit more murkier with the Dow Jones. The Dow Jones, which had been, below, pretty significantly below, about 2.5%, which is kind of the number we look for below the S&P. So we did jump, we did hold that 62% retracement level for support initially, at least, and have bounced up, but still good, almost 2% below the moving average. The near-term line still in bearish territory. The momentum line also still really in bearish territory. The intermediate line getting to the lower half of the chart, hence the dark pink shading, and a red line because we are now below a falling moving average. So that's very different than what we're seeing on the S&P and the NASDAQ. And then your Russell, it's actually broken its 62% retracement. It's actually held the 78% retracement so far. Remember, that you're in a retracement mode once you break the 23, and then you're out of retracement mode when you either break back above the 23 or you're breaking down below the 78, and you're reversing the trend. Well, that's the one that we're flirting with because we got a little bit of a lower shadow there on Friday. We filled, we traded and closed a little bit below that line, just a smidgen. So it's not, I wouldn't technically call this a breakout to the downside. But you do have, we are 4% below the 30-day moving average, so we're well below that. Dark pink shading and a red line. So, those are bearish patterns, market forecast patterns for those major indexes. When you look at the long-term chart, of course, you have, the red arrow on the moving average. We got that on Friday. We're good, strong, bearish candle, Hakunashi candle there, falling PPO and a bearish differential. That is those three signals tell us we're on intermediate decline. And you got the same thing going on the Dow, bearish Hakunashi candle. We're not closing below. So usually you don't close below the prior week's low point because you tend to get longer lower shadows than you get upper shadows when you're bullish. You tend to get smaller upper shadows when you're bullish. You get much longer lower shadows when you're bearish. And so, but again, no upper shadow, and like I said, still the red arrow. Everything else is looking bullish there. So the S&P, you notice, is still kind of very small differentials, negative, but very small differential. PPO is falling, but we're still above that 10-week moving average. So we're not quite to intermediate pullback mode either on the S&P or the NASDAQ. When you look at the three green arrows, we talked about how important it was for there to only be 1 day of light pink shading for that 3 red arrow signal to turn back into 3 green arrows eventually, to be a good bullish by the dip. And that's kind of what we had on the S&P. Remember, the NASDAQ didn't get the light pink shading. It's these other two that are still pretty far away from getting even just a clear and just getting 1 green arrow, much less all 3. So they are, even on these charts, in intermediate pullback mode, these two, whereas the S&P and the NASDAQ right now are not. Of course, when you look, they're also very different on their two lines. The S&P is back above its 30, though it, in the back, it's kind of flirting with the 17, not quite getting back above the 8-day. We're still in convergence mode, so we still haven't really started to diverge again back to the upside. Again, IWM looks very different because, we broke below the 200-day, well below the 50. We are in divergence mode, because bearish divergence mode, because we are we got below the 17. They're both now crossing the 30, and they're going to be very close to crossing below the 50 here pretty soon. And like I said, we're below that 200-day and that close to getting below the point of control, which would be very bearish. And the Dow isn't below its 200-day, but it's same thing with that point of control, and you get below 338, and we're going to be below volume and the 200-day. We're in divergence mode here too. The 8 and 17 both crossing below 30. So these two indexes very different than their large cap peers. The Qs got back above their 8 days, a very bullish pattern there. Still in convergence mode though, so keep that in mind. We're not diverging back to the upside yet because we're not back above that moving average. So the large cap indexes, the S&P, the Qs, are in still bullish convergence mode. On the other hand, the Dow and the Russell are in bearish divergence mode to the downside. So we can kind of see what's working, what's not working here. Here's your DMI for the S&P. Again, we're not bullish anymore. You are below 25 on the positive indicator here. You're well above 20 on the negative. We're not breaking out on the bearish side, but we are definitely not bullish anymore, and we are breaking out on the S&P or the Russell and the diamonds, getting above 30 on the negative, getting below 20 on the positive. Like I said, light pink, dark pink shading and a red line. Your RSI bounced up a little bit. There's your S&P getting back up, get back into the bullish half of these charts. But again, your Russell is not improving. It's still below minus 150. It's still below 40. And your Dow is going to look very similar. Also still below 40, still below minus 150, and haven't broken down below 200. So they are still both in bearish territory levels. Your trend strength indicators, you still show bullish, strong bullish trends on these, but not on the. In fact, you are now in an intermediate decline on the Russell on this chart because you're below minus 2, you're above 65. You're still above the cloud, so it's not. I wouldn't say it's a strong trend to the downside. Kind of same thing with that point of control, right, which is right here for the Dow and the small cap index. You're not quite to those intermediate trending levels here on the Dow either, but you are below the blue line, and it's really important where we go with the cloud, and then of course with these they'd have to get below the blue line first before we even start to worry about weakness there. Here's your Bollinger Bands in the middle of the chart. Brief little drop on Friday, of course, but back to and you can see the Bollinger Band width is down, setting up the possibility for a squeeze play, right? Your Bollinger Bands got inside the Keltner channels. The bandwidth has gotten small enough that they're back inside the Keltner channel. So again, that's setting up for a divergence play. Remember, we're in bullish convergence. That's what creates these red dots with the bands getting inside the Keltners. That's what convergences do. You've got it here too. Divergences is when you get the green arrows down there. So obviously we're in a bearish divergence now as we are outside of the lower Keltner channels, in between the bands and the channels with the green dots and the red momentum. You can see we are definitely in bullish pullback mode there. There's your green dots there, the red momentum. Got below both the band and the Keltner channel on Friday, and you can kind of see getting back up today, but still in divergence mode here in the lower quartile of the bandwidth, as you can see. Diamonds as well as IWM's in the 7th percentile right now, so easily in the lower quartile of the Bollinger bandwidth. So again, the S&P and the NASDAQ kind of behaving like a safety trade, holding value, margin of safety. That's a term I've been floating around for however many months, as the small cap index has stayed sideways here and just built up a lot of volume in this area. As you can see, building up all this volume in this area here is just, created a very poor margin of safety below that. Not the case in the S&P and the Qs. They have a very good margin of safety because they got lots of support below here close by. So we're still in this mode where they're acting as a safe haven. They have better technical charts, but that's not the case for your cyclical areas that are more closely tied to the small cap index. They're mostly more closely tied to the industrial average, the Dow Jones. Those are really getting hit on the chin. And even with the bounce back today, wasn't enough to reverse Fridays like we did see on the large cap index. It's much better reversal for those, but not a very good reversal for kind of like the high growth tech areas like the ARK type investments, right? RKK, those types of stocks, innovation stocks, and you can see how bearish we are there. Below the point of control, flirting with the lower, the value area, that lower chart, and they were very strongly bullish when the small cap index is bullish. When the small cap index went sideways, so did this, and now you can see kind of really flirting with breaking below some very important support levels. So those are the kind of stocks that are bearish right now, whereas your QQQ names, your Apples, your large cap tech, are holding value better, and that's helping the S&P stay bullish. And again, we're not really in pullback mode until everything follows. So the bifurcated market means we're still kind of in convergence mode where different things lead on different days. We're not necessarily strongly bearish, but we're also not really strongly bullish yet either until we get a divergence on a broader level, either to the downside or to the upside. And we're leaning more to the downside day by day here, but not strong enough yet to break to lower the odds of a bullish bounce. So the odds of a bullish bounce this week are still very high, and that's actually what I would expect, since they're holding those values really well, and the Russell's not quite breaking strong support, and the Dow, they're flirting with strong support levels, but they're not quite breaking those. Now, if they break those, then everything changes, but you expect support to hold until it doesn't. So my expectations this week are we still will bounce back up. Safety will still hold, and the Russell and Dow will bounce off these supports. I don't know if we'll finish at higher highs by the end of the week, but we probably won't finish at lower lows either. We'll at least be forming a base and building out these lows that we can eventually come up off of. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. Let me know why and what charts or indicators you're looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen, hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today, you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. You don't even have to watch if you don't like it. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments you have on anything I've brought up in today's videos? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Remember, as I mentioned earlier, our Black Friday sale still goes through tomorrow for anybody looking for that discount on our premium services. Follow me on Twitter for more content between the videos from day to day. There's my handle up there at DavidSettle42, and join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things over here on the right. Click on this icon here, the Market Outlook Live. That takes you to this page where you can watch all of our Market Outlook Live videos, including all the archives. This is where I review all the trades we've done in prior Market Outlooks to see whether we should stay in them or get out of them. We also put on today's trade already, the one that you hear at the end of the video. We already put that on today during this live video here. This is where you watch it on this page. It starts at 3:30 Eastern Time Monday, Wednesday, and Fridays. You can also get to it by mousing over Market Outlook and clicking on Live Trade Review. If you come over here, you can see our upcoming classes. Click on View More. That takes you to our trading room page, our calendar with all of our upcoming classes and previous recordings, 3 years worth of recordings. You can also get to this by clicking on Trading Rooms up here in the main menu. If you come down to the bottom, click that heart. It opens up a new tab. Hit that like button that pops out there. There's usually one that pops out here where you can just hit this heart right there, just like that. That helps us, as well as click on this thumbs up icon. Opens up this new tab. Hit that like button. Again, the more you do that, it helps get our content out to more and more of our followers. It's been a long time since we've been over 200 on how many people have reached this, and we have, well more than 200 people that follow this page. So the more you like it, the more engagements these have, the more all of our followers see our stuff. So it really helps us out. It also helps you out because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here while you're watching the video. Alright, now let's take a look at what's driving the price action. This is, again, our kind of like different asset classes, our risk asset classes, which they really jump off the screen at you because they're the ones that are in dark pink shading and red lines, right? The euro's in a decline, the dollar, the euro's actually been bouncing the last few days. Remember, the dollar's kind of your safe haven, or your risk asset class right now, and the euro's your safe haven. So the euro's kind of bouncing. Of course, bonds have been bouncing the last couple of days. That's put some pressure on the 10-year yield over there. You can see equities, crude oil is down, getting a cluster today so far on the futures contract that started here. The emerging markets were down, well below the moving average. Developed markets are down, well below the moving average. Bitcoin's dark pink shading in a red line. Silver's well below its moving average with dark pink shading. Copper is below its moving average with dark pink shading in a red line. So not very, not very bullish at all. Gold has got a yellow line. It's below its moving average, but at least you got a yellow line. Like I said, bonds, dark green shading, and a green line. U.S. stocks kind of holding up as they're more of a safe haven asset class compared to international equities right now. That's helped the global equities, but you can see global equities are getting to the point where they're well below their moving average, and looking like there's a strong possibility that they can turn dark pink shading, which, because we're only at 53, we're that close, and then also a red line because you're so far below the moving average there. Let's take a look at what's driving the price action here today, and just look at today here. You can see the big drop. The big drop from Friday, but let's look at just today alone, and you can see that equity started off very strongly. I don't know why they're not. I think it's because of the. The Friday. So might have to go out the Friday to get. Because that half day kind of throws off the ETFs here. But so this is Friday's drop, and then the subsequent bounce. So in 2 days now, including Monday, look at commodities, emerging markets, small caps. Those are your risk asset classes right now. Those three, they got hammered. 3% down in 2 days, 4% down in 2 days. Like, they didn't come off their lows. Emerging markets a little bit, but not really. And small caps is right at the lows, and commodities also 6% right at its lows. They didn't change. Real estate also getting hit pretty hard. The Qs are actually backed up to being positive, so they actually now they pull back here late, but they still have a positive return for the 2 days, which, coming off of a near 2% drop on Friday, that's a pretty big rebound for these large cap tech names. And you can see, even with the drop, that long-term bonds are still bullish, gold still outperforming, the dollar still outperforming. So, still very safe haven oriented. In fact, remember, the dollar's been, a risk asset class here. If I take a look at, you see how bullish the dollar was there, and it's a safety trade compared to these asset classes. But if you compare it to these other currencies, we'll do the currency comparison here. And again, just go over the last 2 days here. So we'll go to November, and we'll go to the 26th. Let's go at like 5 minutes on this. So remember, the dollar is this horizontal line, and you can see all the commodity currencies are down, because remember, commodities are so bearish. So they're getting hammered. But if you look at everything else, all these European currencies, including the other two major safe haven currencies, the yen and the franc, they're really outperforming. The Mexican peso has been doing pretty well too, and the euro's up 0.75% over 2 days. So it's so again, the euro is behaving like a safe haven trade, more so than the dollar is. Your pound outpaced a little bit, and then, like I said, everything else here more associated with commodities, all really getting hit hard with the drop in commodity prices. In fact, if you take a look here at some of those, we saw that the euro is having some strength. Its market forecasts have been getting a ton of clusters and been well below its 30-day moving average. You're still pretty good below, and you still don't have the strongest near-term rally. So still don't really have a huge threat to really get going to the upside. But remember, if it does get going to the upside, it's probably going to be more associated with risk off than it will be risk on, which is what you would typically expect. Here's long-term bonds. Again, dark green shading the green line. The intermediate line still above its market sentiment, trying to make another run at the bullish territory. And then you can see how bearish the commodities are. Dark pink shading, red line. We have light green shading because the intermediate line went up a little bit, but still easily in bearish territory. And your short-term sentiments very oversold. So we're not. This doesn't look like it's changing its trend anytime soon. In fact, when you look at the 3 green arrows here for commodity prices, we're easily below the 50-day moving average. We've broken down, so we are in pullback mode. Of course, we're filling in that gap to the 200, but if you break that, that's where it really gets bad. We don't really have to worry about that too much yet. There's your euro US dollar above the 8-day moving average. Remember, getting above the 17 is what really changes things. And like I said, if it does get above the 17, that might be more risk off than its normal risk on pattern that we typically see. There's your long-term bonds, kind of again trying to figure out this point of control. Do we get above it and where we're bullish? Do we get stay below. You can see the moving average, 30-day moving average, now crossed back up above the 50. So you kind of got that mini. We've got the longer term golden cross when the 50 crossed the 200 right there. But then we had this pullback, not long enough to get the 50 back down below the 200, which would be risk on because this is long-term bonds. But it did bring the 30 below the 50, and now the 30 is back above the 50. So kind of like this long-term golden cross and this more intermediate mini golden cross with the 30, and with price above the 8-day and the 8's above the 17. The MACD's positive, stochastics back to rising, back above 40. So it looks like bonds are trying to kind of get going again to the upside. Let's take a look at the 12 grid for the U.S. sectors. You can see your cyclical areas up here, light pink shading. Communication services looking pretty bearish. Look at financials, industrials. They're well below moving averages. Materials and energy not so much. And then of course your safe havens here kind of showing some relative strength. In fact, if you look at the relative strength chart, you can see your utilities moving up in the blue, up to the right. Real estate's moving up to the right. Materials moving down to the left. You got energy, financials, communication services, industrials moving down to the left. Healthcare, all kind of showing some relative weakness. You still got relative strength in technology and discretionary, but they definitely don't have high momentum right now. Your strongest momentum is utilities and staples and real estate. Those are your highest momentum sectors, and they're all moving over to the right to the point where they're almost now getting relative strength, and you're losing momentum on these areas. Discretionary is moving up, but still from really, really low levels. It's still relatively low compared to some of these other sectors in terms of momentum. Here's the comparison chart for the sectors. If I were to come over here to, again, the last couple of days, the 2 days, so we'll go to the 26th. You can see that, of course, energy, financials really got hammered. Industrials too. Healthcare, your safe havens outperformed. So 2 days now, utilities and healthcare are pretty flat with XLK, which again, you can almost consider with utilities another safe haven, considering how blue chip they are. And then you can see industrial, financials, energy, more cyclical oriented, especially considering they're linked to kind of this reopen trade, and those are strong returns to the downside, and you can kind of see the rotation out of those areas and into cyclicals. And again, everything drops when you're really in risk-off mode, as you saw. If I were to go back to when we started our decline, let's see here. When did we start our risk-off? The previous intermediate decline, we kind of peaked there on September the 2nd and bottomed out around October the 4th. So just kind of give you an idea of, when we were in this intermediate decline before, you can see that everything fell. Energy held up, really bounced up here at the very end, tail end of that. But XLK was down, XLU was down, XLRE was down, safe havens were all down. Materials was down. You only had a few kind of outliers that weren't down nearly as much. It's not very typical of a risk-off move, but this is when everything kind of all goes down together. All right, so for our trade the other day, I wanted to take a look at Anthem. It's pulled back. I had a good post-earnings breakout with a cluster. When you get these clusters at the beginning of an intermediate run, that's very bullish. So very good. Obviously, not surprising to see a consolidation after kind of a bullish breakout there. We've consolidated to the point of light pink shading in the yellow line, which is a good bullish pattern. The intermediate line has dipped below the market sentiment, but not out of bullish territory, still above 60. Short-term sentiment has pulled back, so there's an opportunity that we can bounce off of this low and start heading back up again, especially considering you got 3 red arrows before today's green arrow on the stochastics way down here. There we go. You can see the green arrow down there in stochastics, but you had 3 red arrows. You would expect that we can bounce off of that 3 red. You can see we already don't have another day of light pink shading because you got that green arrow there. So a very good sign from a market standpoint, with the idea that we might not be as bearish. And if you look at This chart, we're not really that far below 50. We're just a smidgen below minus 100. Definitely not below minus 150. Not below 40 on the RSI. When you look at the directional movement index, we're not bullish here either, but we're not bearish, right? We're not above 30 on the negative. We are below 20, but not too strongly bearish there. The trend strength indicators, excuse me, right here. You can see them. We don't have a trend. Like, we were strongly bullish. We kind of broke it, but we're not bearish either, right? Very, very noisy move. We're still just a couple of days below the blue line, well above the cloud. So an opportunity that we can bounce off of support here and work our way back into the upper half. We're well above the point of control. We're above the value area. That's the breakout. We made a return move. And you can also see too on the 2-line version of this chart, we've come down towards that 50-day moving average. We're not really, we're kind of filling in the gap between the 30 and the 50, but by the 50 rising. You can see where we've had this bullish convergence. We're not really starting to diverge too strongly away because we're still just a little bit below the 30-day, and we'll see if we turn back up. And that's kind of the expectation here. So for the trade idea, we decided to sell the $400 strike put around the mid-30s in the delta, buy the 390. Again, trying to get at least $2.32. That's what gives you a 30% return on risk on a $10 wide spread. Looks like we ultimately got, let's see, what would that be? $2.80 on it. $2.80 there. So if I set that slice to break even and I set that slice onto the chart, you can see we'd have to break back down below the 50, well below the 50, break below this volume node that's inside the value area. These old highs, it's going to act as a very strong support level. We'd have to break that support for us to now get to the point where we'd be down. At that point, we'd only be down about $170, and we're willing to lose $280. Remember, we're only risking $720. That's why that number is a little bit smaller than normal, because we're not risking the full 1,000. We're actually risking only about 700, which gives us, at 280, a little bit more than a, it gives us about a 40%, close to a 40% return on risk. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. You can open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Click that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Monday night, everybody, and we'll see you all next time.